We all know that investing is hard, and at times it can be very overwhelming. Because right when you think you found the perfect stock and you actually purchase the security, this is what happens. Your stock crashes 20%, you're left there with your thoughts, you thought you found the perfect stock, and now you're in the negative, you're losing money, and you don't know whether you should buy more, whether you should sell, and you quickly become discouraged. However, as Peter Lynch states, the most important lesson an investor can learn is to be dispassionate when confronted by unexpected and unfavorable outcomes. Meaning that the best thing to do is just remove all of your emotions away from investing and set a clear strategy. But the thing is that this scenario is a lot more common than we believe. Most individual investors actually lose money over the long term. But then why do we keep investing if we're so bad at it? Well, because we want to hope for a better future. And we know that the indices are actually having a very positive long-term outlook. And when investing is actually done right, you can make a lot of money and improve your life conditions for the future. But there are a few important things you should actually do in order to become successful here. One of them is what Shelby MC Davis states. You should invest for the long haul, don't get too greedy, and don't get too scared. And the second one is that you should actually have a sound strategy which you develop tailored to your needs and to your specific situation. And today we'll actually be looking at how you can create a personalized strategy tailored to your needs, to your specific circumstances, in order to maximize your chances of being a successful investor and generating a lot of money over the long term. So let's jump straight into it. There are many different reasons to become an investor. Not everyone wants to do this in order to become extremely rich by investing in growth stocks. Some of these investing objectives include saving for retirement, generating regular income, achieving capital appreciation, preserving wealth, and even optimizing taxes. And believe it or not, depending on which objective you're actually looking for, your portfolio and your investment strategy will look extremely different. And another thing you should define along with your objective is your time frame. Of course, you should approach investing in a different way if you're going to be investing for the following 20 years than if you're only going to be investing for the following 5, because it's when you were expected to be retired and when you'll actually want to withdraw your capital from your portfolio. Now we can link this to a quote by Charlie Munger, where he said, "A lot of success in life and business comes from knowing what you want to avoid. Early death, a bad marriage, etc." Well, here, a lot of success in investing comes from knowing what you want. Defining your objective and setting a time frame is not an easy task, but is something that you must do in order to create a proper strategy. Next, and very important, is defining your risk profile. Now, as we discussed, this is heavily related to your investment objective. However, not everyone has the same appetite for risk. It's important for you to define this because if you don't have a very high risk profile, you should not be looking at low cap, high growth stocks. You should probably be looking more at higher cap companies or even at bonds. You do have to consider that although this may not always be true, the lower risk you want to take, usually the lower your returns will be over the long term. However, with investing comes risk. And as Peter Bernstein said, risk taking is an inevitable ingredient in investing and in life, but never take a risk you do not have to take. At the end of the day, creating a strategy for investing your lifetime savings should actually allow you to sleep sound at night. You do not want to be having nightmares because your portfolio is down around 40% when you have a very low risk profile and would already be stressing out if your portfolio was 10 or 15% in the red. Once you have defined these 3 things, you then go into the research phase, where the factor here is to investigate and conduct some research on the different asset classes in the market. Of course, this is because if you have a higher risk appetite, then you will likely be looking at stocks, cryptos, or even other alternative assets. On the other hand, if you have a lower risk appetite, you will probably be looking at bonds, commodities, gold, or mixing up your portfolio with a combination of these different assets. And by researching them, you can understand them, understand yourself better, and then have the knowledge to be able to create a better performing tailored portfolio. Next, and this is very important, you have to understand how much time you want to dedicate to investing. This, of course, may change depending on your job, on your family situation, and on the fact that you actually enjoy researching and learning about this topic. So my recommendation is if you have less time dedicated to investing, for you to actually dip into index funds, mutual funds, wealth managers, or even private equity if you're on a higher income scale. These are better options for you because you don't have to be managing your investments, you don't have to do a lot of research once you've actually found your funds, and you can just leave your capital there, even automate your contributions, and your capital will be appreciating in the background while you can dedicate your time to other things that you enjoy. However, if you have a lot more time that you want to dedicate to investing because, for example, you enjoy it a lot like I do, chances are you will perform better with an index fund, but you can also dedicate your time to research properly how to conduct stock picking, which can either be a very lucrative hobby or a horrible selection. But regardless, or if you pick stock picking or funds, you can then conduct other tasks such as portfolio optimization, investment tracking, and performance analysis to have an idea of how your funds are performing over time and adjust it if you believe that it should be adjusted at any given moment. Again, one thing to remember here, especially if you have more time that you want to dedicate to investing, is that any superiority an investment process may have will only emerge with time. So patience is extremely important. If you have already developed a strategy, unless you're extremely disappointed with it, you should give it 2 or 3 years to play out and then actually review how it has performed and tweak anything you want to change. Next step is that you should define your portfolio allocation. Now this is great because we have already defined your objective, your time frame, your risk profile, and you have done a lot of research on the different asset classes. So you can already start to look at how to diversify it, the different correlations between the different asset classes, or you should define how you want to divide it. Even if it's very simple, such as I want 60% of my portfolio to be allocated to stocks and 40% to be allocated to bonds. Something as simple as that will work. This is only for you to make a commitment. Write down your investment thesis and then follow through. If it's not written down, you will probably forget and you will probably start to do something different. And remember, without time and patience, investing is nothing. Over here, you have the allocation for the famous all-weather portfolio, which was created by Ray Dalio. In theory, it is one of the portfolios which performs the best for its given risk profile. And you have down there the possible indices you can use to create this portfolio. While you're creating your portfolio allocations, I would recommend you to do some backtesting. If you have never heard what this is, there are a lot of websites where you can actually backtest, meaning that you can see how the performance was over the past years, how much your max drawdown was, which is basically the largest percentage that your portfolio fell since its all-time highs. There you can see, for example, which number you would feel more comfortable with, and you can see out a lot of other KPIs and even compare portfolios between one another. And this is perfect if you're having doubts and you want this portfolio to represent a long-term investing strategy. You do have to remember that although you backtest your portfolio, your future returns will probably be completely different. However, I think this is a good strategy, especially if you're a beginner and you want to learn how different correlation between different asset classes perform over time. And as Ivan Way said, patterns don't work 100% of the time, but they're still critical because they'll help you define your risk. If you ignore patterns and focus on the hot tips, you just forget about achieving consistency. Now it's time. You already have your strategy, you have your portfolio, you've done the research, and you've put a lot of time into this investing process. My opinion is that you should start as soon as possible, even if you don't have a lot of capital, and increase the contributions over time. The important bit is not how much money you can add at the start, but how consistent you can be with your contributions over time, even if it's only $100 a month. As all-time Warren Buffett said, time is your friend, impulse is your enemy. Take advantage of compound interest and don't be captivated by the siren song of the market, meaning don't get scared. You will do fine as long as you have a long-term approach. One thing that I do want to focus on here is that although I believe you should start as soon as possible, this doesn't mean that you should skip all the research and all the strategy creation process, because that is essentially the most important part. You need to do your homework. I saw an interview once that talked about why the average investor was so bad at investing. And the main reason is that people just don't put the effort they should into investing. When you're analyzing whether you should buy, for example, a washing machine, which costs $1,000, you will maybe spend 2 or 3 weeks researching the different washing machines, seeing which one is the best price and which one is the best quality. However, when people are researching about stocks, they'll just listen to hot tips or analyze a stock for 5 minutes and believe that that is their best investment ever. But this is not how it works. You should put the time, you should do your homework, and if you can't do that, then at least just ideate a strategy where you will add into indices. And one extremely important thing to remember is that these strategies can evolve and should evolve over time. Why? Well, because over time you will have new financial goals. Maybe your first financial goal was to buy a house in the following 5 years. But now you actually want to focus on retirement. You will have different risk tolerance. Maybe you will start a family, and that will make you want to take up on a lot less risk than you were doing before. You can also have a change in your time horizon. You can want more portfolio diversification. Maybe you had a lot more time and you started to do your homework and research all about investments, and you decide to switch up your portfolio allocations. And finally, maybe just because of your regular review and your portfolio rebalancing, you're changing up your strategy, which is okay. Investment strategies are supposed to evolve over time. However, one thing that I believe is that you should not very often change them completely. It should just be a small change, but always remembering that the stock market is a device to transfer money from the impatient to the patient. A quote by Warren Buffett. So finally, I just wanted to leave you with all the steps inside the same slide to create a successful investing strategy. Of course, this is a very rapid guide. The process can look different and take a lot more time, but just for the video, it will do. You should set your goals and define your time frames, then understand your specific risk that you can manage, learn about asset classes, how they perform in different economic environments, how you can diversify your portfolio, and apply all this knowledge to then create a draft portfolio and backtest until you find one that will allow you to soundly sleep at night. After this, you're ready to start investing, and start investing early so that you can start compounding. And finally, just keep a track of your portfolio, even if it's a yearly track. Investment strategies can evolve over time, and you should take a look at this. What is my investing strategy? Well, I like to stock pick. I love this and I do this as a hobby. So my investing strategy is and will always be to find undervalued companies which have great financials and just buy them whenever there are dips and sell at the very end whenever my conviction has changed on them. And always live by this quote by Benjamin Graham, where in the short run, the market is a voting machine, but in the long term is a weighing machine. So thank you for watching. As always, this has been the Cashflow Compounder. Join the free Patreon for extra content, and there is a link where you can save up to $15 when signing up to TradingView.